If you believe that that's going to somehow magically save the stock market, you are completely and utterly ignoring the evidence.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers. Welcome, everybody, to Talking Trades. Of course, it's Kevin Wadsworth and I, Patrick Karim, bring you today some very, very macro and important charts. And I guess, Kevin, we could call this also myth busting because it has to do with the Fed fund rate cuts or anything that the Fed fund rate changes, what happens to it, and what can happen to markets. Often we hear, oh, it's a cut, off we go, bull run continues. And we're here to show some truth, and nothing better than charts to actually give you the objective, unbiased truth on what's actually happening.
Exactly, Pat. Well said. And if we take a look at those charts, I'm just going to load up for you. We're going to take a look here at gold, the SPX, and as they say, what happens to stock markets when we get rate cuts. What can we expect? Just taking a look first at gold and the stock market and just setting the scene for what can happen during stock market drops. We've got several significant drawdowns here shown on the SPX chart. So we've got the candle chart in the background there. That's the SPX, the stock market. And we've got the gold chart shown in orange here for you. So you can compare what happens to the stock market and what happens to gold. Okay, so when we see these big drawdowns for the stock market, and you can see during the 1970s, we had a couple of drawdowns. One was 35% and one was 50%. And those big drops were associated with gold's biggest bull market of all time, in fact. Now, gold doesn't necessarily have to plummet when the stock market begins to drop, but there's often a pullback at some point, but it doesn't necessarily follow. It depends largely on the nature of the event that's causing the stock market drop. I'll just expand the scale for the stock market there for you so you can see it a little bit more clearly. And I'll go forwards to the 2000s. And you can see what happened in 2000, in fact, as the stock market began to top and roll over. It fell 50%. Okay, there's a 50% drop for the SPX there. And you can see gold's reaction. After an initial relatively small drop for the price of gold in US dollars, we accelerated pretty rapidly out of that. And as the stock market recovered, gold went up as well. Now, the stock market merely reached its previous high. Gold surpassed its previous high and kept on going, kept on going. In fact, it went from somewhere around $250 to somewhere close to $2,000, something like a 9 times increase for gold. And during that entire period when gold went up by a factor of 8 or 9, the stock market had gone sideways. But notice that during the recovery periods for the stock market, gold did exceedingly well. So the takeaway from that is that during these large drops, there can be an initial reaction in precious metals. But when you get these large drops, that rollover, that flow of capital that finds its way elsewhere very, very rapidly has an effect in those markets, gold, silver, commodities. And you get a strong outperformance for the precious metals versus the stock market. And of course, you can see at the moment that gold and the stock market are going up together. In fact, they've been going up together for approximately 6 or 7 years now, since 2017. So both gold and the stock market are rising together. Now, Patrick mentioned a little bit about rate cuts. So what can we expect if the Fed decides to start cutting rates? Well, let's look at history and let's go back and see what happens when the Fed fund rate is cut, when we get a pivot. So you can see the green bars on the bottom of this chart here, and that's when Fed fund rates are rising. And you can see the red bars when Fed fund rates are being cut. So the pivot, if you want to call it that, is the point at which the rate rises, pivot into rate cuts, reverse direction, if you like. Now, looking at the top there, the graph at the top is the stock market, it's the SPX. So very often, in fact, I would go as far as to say on the majority of occasions, when you get a pivot and rate cuts, it tends to be associated with a weakening in the stock market. And sometimes it's more than a weakening. Sometimes it's a drop of 50% or more. We saw 2 drops of 50% or more in the early 2000s. There was a drop of 50% in the stock market between 2000 and 2003. And then there was a drop of over 50% between about 2008 and 2009 there, that period that we all remember where everything plunged. And again, as I said, of course, precious metals massively outperformed coming out of that. So the expectation that Fed fund rates being cut is going to lead to somehow a saving of the stock market is something of a misnomer, and it's a bit of an urban myth that is what will happen. So if you think that the Fed fund rate being cut by 0.25% or 0.5% later on this year, and then perhaps being followed by another rate cut, and perhaps even leading to a rate cutting cycle, if you believe that that's going to somehow magically save the stock market, you are completely and utterly ignoring the evidence. Yes, there is one or two occasions when cutting of rates does help the stock market. It all depends, and it critically depends on the reasons behind the rate cuts. What's going on in the economy? What is it that's causing the Fed to pivot? Is it something good? Is it something bad? Is there a problem, an underlying problem going on with the broader markets? And this type of chart, this type of analysis helps you to identify the probabilities, the possibilities, the odds, the likelihoods, because that's what we're talking about with technical chart analysis, and in fact any kind of technical chart trading or strip trading more generally. You look at the evidence, and you never just look at one piece of evidence. You have to look at multiple pieces of evidence across multiple markets. And this is one piece of evidence. And this one piece of evidence tells us as technical chart traders not to automatically expect the stock market to start rising just because the Fed has started to cut rates. In fact, if anything, it tells us the opposite. And if the stock market does start to tumble and does start to cross below critical support lines, when it's reached a point where it's perhaps a little bit stretched, technically stretched, then that may start to lead to some sort of movement between the stock markets and precious metals. And that involves another ratio chart that we look at very often, and that's gold versus the SPX, the gold to SPX ratio, which we'll cover in other broadcasts, of course. So that rotation of capital from stock markets to precious metals and how that interacts with Fed fund rates being cut is all part of a recipe that leads us to either expect precious metals to do well over the coming years, or to expect precious metals to not do well over the coming years. And this chart with Fed fund rate evidence is critical to that piece of work and to that decision making process. What do you think about that, Pat?
No, I could have said it better, guys. Look, you need some data. This is the objective data, right? Using brilliant chart visualization and annotations, Kevin has shown you the percentage of chances that what happens to the stock market when you get those cuts. And you got to go by those odds, right? Most of the time, cuts happen. There's a market downturn there.
Indeed. And this just to sort of mention as a sort of a side point as well, this is the correlation coefficient between Bitcoin and SPX. So it's showing how correlated Bitcoin is to the stock market. And this seems to follow a little bit of a cycle as well. And at the moment, the correlation, this is on the quarterly chart. So the correlation between Bitcoin and the stock market is rising, and it's approaching that 0.7 highly statistically significant level that statisticians use to signify a very strong correlation between two instruments. And as it is, we're above 0.6 on the correlation coefficient. So we're seeing a relatively strong correlation between stock markets and cryptocurrencies. So if you're into cryptocurrencies and you're of the view that the Fed coming along and cutting rates is going to be good for cryptocurrencies and for Bitcoin, then this must give you pause for concern as well. Because if the stock markets don't do well and Bitcoin is having a relatively high correlation to stock markets, then that must, as I say, give you some cause for concern in the longer term with Bitcoin and the stock markets. Okay, guys, that's it for this episode of Talking Trades. Don't forget to follow us for more content, and we'll see you again very soon. Bye-bye for now.